Hello everyone, welcome back to the channel. So it's been a long that I haven't done anything on this channel, so today we are back with this. So yeah, let's go. So today we have a very important topic, that is Pigouvian Tax. It's a very important topic in the field of environmental economics, and somewhere it is very much connected to the public policies, that is the fiscal policy, or you can say the government taxes that is being imposed in the country. Okay, so before moving to the actual concept of Pigouvian taxes, we have to know certain few concepts to relate it in a better sense. So the first that comes is externality. So what is externality? Externality. So you can see a word here, external. Okay, so what does external mean? You can relate it with that term. So external means what? That something has been done outside our control, you can say. So in externality, what happens? A thing is done by someone else, but we as a third party get affected by those things. Now this externality is again of two types. The first is positive externality, and the next is negative externality. Now both positive and negative externalities has impact on what? Third parties. Fine. Now the first thing is, what is positive externality? This positive externality, as the name suggests, positive. So it means it has some positive effects. So what happens in this? In positive externality, a thing or some kind of economic activity is done by some other person, and me, suppose me, in that case I am that person. So what happens? I get affected positively from those activities. For example, I can say that suppose someone has a house, okay, and in that house what happens? They have a veranda, and in that they are doing some plantations of the flowers, okay, so they have a garden in it. What happen is that the neighbor, okay, the neighbor is getting some positive externality from it. Maybe it's a fresh air or the beautiful fragrance of those flowers, things like that. So that is positive externality. So in that, simple as that in a positive externality, the person is not paying anything, but he is getting some external effects from outside and it is benefiting him. That is positive externality. The next, as the name suggests, it is negative. In negative externality, what happens? You are getting affected by someone else's activity, and that is affecting you negatively. So in here, what happens? For example, I can explain it to you. Suppose suppose there is an industry, they are doing all the industrial works and everything, but then what they are doing, they are exposing all those chemicals, waste materials into the river. Suppose that river is flowing to a neighborhood village, and the people from those village are using those water, that river water, to do some other kind of activities. In that sense, what happens? They are using a polluted water source. So that is negative externality. They haven't done anything to make it polluted, but what happened? They are getting affected because someone has done something in some place that is affecting them negatively. So that is negative externality. So you are getting affected without doing anything, without paying for those activity, yet you are negatively getting affected. Those are negative externality. Fine. So now where does this Pigouvian tax comes in this place? So normally we know, what does a tax do? A tax aims to stabilize the economy. Normally it is used for those situations to maintain stability in the economy. Now this positive and negative externality does what? They disrupts the function of Pareto efficiency in the economy. Okay, so what happens? You are getting affected without paying anything for your services, right? So that means what affects the economic stability. So in that sense, what happens? To balance this positive and negative externality effects, Pigouvian tax was introduced. Okay, so after understanding the basic concepts of externality, let's move to our main topic, that is the Pigouvian taxes. Now, before understanding the Pigouvian tax, we have to understand a simple timeline. So the first thing is Pigouvian taxes was given by Arthur Cecil Pigou. He was an English economist. He was alive from 1877 to 1959. In 1920, okay, he published a paper, that is the Economics of Welfare. This Economics of Welfare popularized the concept of externality and Pigouvian taxes. In that, what he did, he introduced two more important concepts, that is incidental uncharged disservices and incidental uncharged services. So this incidental uncharged disservices shows the negative externality. Okay, so what happens in here? According to him, when the industry produces a good, so in the process of production, an industry creates two kind of things, that is the marginal social benefit and marginal social cost. So when in that process, what happens, the industry normally covers the marginal social cost when they see that their marginal social benefit and private social benefit are going in the same direction. So in this, marginal social cost is the cost of the society and marginal social benefit is the benefit to the society, but private benefit is the benefit of the industry. Fine. Three things. So he says that when the private marginal benefit and the social marginal benefit does not goes in the same direction, that is they are not diverging in the same direction, at that situation what happens, the industry stop paying for those social marginal cost. That means they are not getting the benefit of the private marginal benefit, so why they will pay for the social marginal benefit? So because of that, they stop paying the social marginal cost also. So that is termed as the incidental uncharged disservices. So that is uncharged and that is disservice because it is negative externality. Opposite of it, what has been introduced by him is the incidental uncharged services. In that, he has given that an individual is not paying for any incentive that he is receiving in the form of social marginal benefit. Okay, so what he is doing, he is not paying for any externality, positive externality he is receiving. So that is the not paying for the social marginal benefit, that is termed as incidental uncharged services. So to balance both those things, what he has done, he has introduced Pigouvian taxes for this. Okay, he has introduced Pigouvian taxes for this, and for this Pigouvian subsidy. Introduction of these two things, what it basically means is that Pigouvian subsidy will be given in the case of positive externality. So any industry or any institution or anything that is creating positive externality, as they are not getting paid enough for those positive externality, they should be given some kind of subsidy to balance those situations, so that the positive externality should be produced more in the economy and it will create more social benefit, social welfare in the society. In the opposite case, he has done what? He has introduced Pigouvian tax. So in Pigouvian taxes, what happens? He has said that the government should charge more taxes from the industry which are not paying for the social marginal cost that they are creating, which is leading to the negative externality as a whole, because it is disrupting and negatively affecting the society. So those two are the situations he said. So in as a whole, he said that when the Pigouvian taxes are applied and Pigouvian subsidy are given, both of them will balance the negative and the positive externality in the society, and it will be a balanced economy again. Okay, but till he has given all those concepts, it was not popularized at that time yet. So later on in William Baumol, what he did in 1972, he popularized the concept of Pigouvian taxes and Pigouvian subsidy, because until then environmental taxes was in more focus. Okay, so Pigouvian taxes concept was not so much accepted or like acknowledged by the economists or public accountants at that time. Okay, so after this we will go to the actual diagram where it will show how Pigouvian taxes can actually be implied in the society. We are finally at the diagram. So in this diagram, let's go step by step. So we have two axes, y and x. In the x-axis we have measured output, in the y-axis we have measured prices. Now this 45-degree line is the marginal social cost line. This line is the price is equal to the marginal revenue line. That is the general thing that we have learned till now. We have learned earlier also. Now this line is the marginal private cost. That means that is the marginal private cost that was incurred by the industry, and at that time it was intersecting the price line at E. So that means they were doing an original production at this level, say Q1. Okay, but what happened because of this, an externality was negative externality was being created in the society, because the marginal social cost was at that line. That is, a marginal social cost is here, but you are paying only for the marginal private cost. You are not covering the marginal private cost, marginal social cost. So what Pigou introduced is taxes. So he said that you have to introduce a tax that will equal the extra amount that is left to cover the marginal social cost. So that tax was here introduced as AO. So when the government introduced that AO taxes, the price line, the payment of the done by the industry gets shift away to this parallel shift, and it intersect this marginal social cost at this point C. Now at that situation, what happened? The industry is forced to reduce their production of those negative externality, so it shift the original output to a new output, that is say Q2. Now in this situation, what happened? This marginal social cost is being covered, and this particular area, okay, what you see here is the total revenue that the government is getting right now, because they have incurred the taxes on the industry. Okay, so this is the basic thing that happens in the Pigouvian taxes. Like any other economic topic, this Pigouvian taxes is also not relieved by the influence of criticism. So the very first criticism that this Pigouvian taxes has is that it is, what can I say, not measurable or countable. So what is not countable? According to other economists, the externality factor that he is mainly focusing on to introduce the taxes, that externality is not measurable. So what happens here is, if externality is not measurable, how can you introduce the taxes to cover up those externality, right? So what happens here is, externality is a feeling or is an utility factor that comes into play, but utility, as we know, it can't be measured. So it has this first criticism that the externality, both positive and negative externality, cannot be actually measured. So it creates a problem in that part. If you can't measure externality, how can you know how much taxes or subsidy has to be given to balance out those effects? Okay, the next thing is, many critics says that even if the government gives subsidy, the individual will not know. Okay, the individual will not know that they are actually being given any kind of subsidy. So normally what happens when government gives some kind of subsidy in the form of public education or health care, what happens in that situation? Also, the government thinks it's a duty of the public administration to give those kind of welfare to the people. But actually what happens, they are giving a subsidy to the people in the form of positive externality. They are giving money to the healthcare industry to introduce free services, free healthcare services to the public, and public are not paying for those externality, but people don't realize that they are given some kind of subsidies by the government. Okay, now the main thing is this criticism, this has disrupted the whole concept of Pigouvian taxes in the modern economics part. But even with all those criticisms and everything, Pigouvian taxes has been introduced as a very very important concept in the economic world. There are many countries like Canada, USA who are actually doing this tax shifting and all those Pigouvian taxes implications in one form or the other to neutralize the effects of externality in the world. So though it comes with some kind of criticism, but Pigouvian taxes is a very important concept introduced by Arthur C. Pigou. With this, we are done with today's class or discussion, you can say. Mainly in the next class, let's meet again. Subscribe to the channel and leave a comment or any doubt you have here, and I will really appreciate it. Thank you.